Bitcoin's journey in 2025 has been nothing short of dramatic. Just hours ago, the world watched in awe as Bitcoin smashed through its previous records, surging past $124,000 for the first time ever. That number, $124,002.49, didn't just represent a new milestone for the world's largest cryptocurrency. It sent shockwaves through financial markets, igniting a frenzy of speculation, excitement, and, for some, fear. Yet almost immediately after reaching this historic high, Bitcoin experienced a sharp and sudden correction. Within minutes, the euphoria faded as prices tumbled, leaving many retail investors stunned and uncertain. It's the kind of volatility that's become synonymous with crypto. But this time, something deeper is at play. The trigger for this abrupt crash? News broke that Google, one of the tech world's most influential gatekeepers, plans to ban unlicensed crypto wallets in both the United States and the European Union. This move, effective December 2025, will impact millions of users, restricting access to non-approved wallets and potentially reshaping the way everyday people interact with digital assets. The announcement spread fear like wildfire across social media and trading platforms. Investors scrambled to understand the implications, wondering if this signaled the start of a broader crackdown on crypto. Red candles flashed across screens worldwide as liquidity drained and panic selling ensued. But step back and look at the bigger picture. This isn't the first time fear has been used as a tool in the crypto markets. Historically, periods of heightened uncertainty and regulatory anxiety have often coincided with aggressive accumulation by large players, institutions, tech giants, and even governments. When retail investors panic and exit the market, prices drop, offering prime buying opportunities for those with patience, resources, and insider knowledge. The narrative of fear is powerful, but it's also predictable. Those who understand its mechanics know that beneath the surface, accumulation often takes center stage. Consider the psychology behind these moves. Restricting access through wallet bans and regulatory hurdles pushes users into approved channels. It's not just about compliance, it's about control. When big players know where the money is flowing, they can shape the market in their favor. It's a pattern that's played out time and again, from traditional finance to the digital asset revolution. Retail investors feel the pain, while institutions quietly position themselves for the next leg up. Let's pull back the curtain on what's really happening behind the scenes. In the days leading up to Google's wallet ban announcement, Bitcoin overtook Google itself to become the fifth largest asset on the planet by market capitalization. This was a symbolic shift, underscoring the growing dominance of decentralized money in a digital world. But the irony didn't stop there. Just days after publicly declaring its intent to restrict unlicensed wallets, Google executed a major deal in the crypto mining space. The tech giant acquired an 8% stake in TeraWulf, a leading Bitcoin miner, through a massive $3.7 billion transaction. This move was hardly publicized, but it speaks volumes about their true intentions. What does this tell us? Smart money moves quietly. It's not about chasing quick profits in a volatile market. It's about securing a strategic foothold in the future of finance, and perhaps even the future of energy, given Bitcoin mining's evolving role in grid stability and renewables. When institutions like Google make headlines for regulatory crackdowns, they're often accumulating behind closed doors. Retail investors see the headlines and panic. Institutions see the headlines and buy. Wall Street's interest is equally intense. Major investment firms, hedge funds, and even pension managers are increasing their exposure to Bitcoin and Ethereum, drawn by the asset's performance and its role as a hedge against macroeconomic uncertainty. The recent executive order by President Donald Trump allowing crypto assets in 401k retirement accounts has only accelerated this trend. For the first time, millions of Americans may have direct exposure to Bitcoin and Ethereum within their retirement portfolios. This regulatory shift isn't just a short-term boost. It's a structural change that could fuel sustained demand for years to come. Regulatory clarity is emerging too. The chair of the Securities and Exchange Commission recently confirmed that self-custody of cryptocurrencies remains protected under U.S. law. This assurance has calmed some of the panic, reminding investors that while access may be restricted in some channels, the core principles of ownership and financial sovereignty remain intact. Fear may dominate the headlines, but the infrastructure for self-custody is stronger than ever. But perhaps the most significant development is happening at the highest levels of government. The United States Treasury Secretary has publicly confirmed that the federal government currently holds between $15 and $20 billion worth of Bitcoin, most of it acquired through asset confiscations related to criminal cases. Rather than liquidating these holdings, the government is quietly building a strategic Bitcoin reserve, a move that signals a dramatic shift in how national treasuries may view digital assets. The plan, reportedly, is to expand the reserve without increasing budget spending, leveraging confiscated assets and targeted purchases to cement America's status as a Bitcoin superpower. This revelation has profound implications for global finance. If the U.S. government continues to add to its Bitcoin holdings, it will create buying pressure that could drive prices even higher. More importantly, it signals to other governments and institutional investors that Bitcoin is not just a speculative asset. It's a strategic reserve, a hedge against inflation, and a tool for financial sovereignty. The era of underexposure is ending, and as more players rush to catch up, the market could see another leg of explosive growth. Ethereum, meanwhile, is quietly building its own bullish setup. In the wake of Bitcoin's surge, Ethereum reached $4,780.04, its highest level since late 2021. This rally is not just about price action. It reflects Ethereum's growing role in decentralized finance, staking, and blockchain infrastructure. The transition to a proof-of-stake model has dramatically reduced Ethereum's energy consumption, making it more attractive to environmentally conscious investors and institutional asset managers. The network's upgrade has also improved scalability, driving adoption across DeFi protocols and institutional platforms. A new competition is emerging within the Ethereum ecosystem. On one side is BitMine, a treasury-focused entity with aggressive accumulation strategies. On the other is Chainlink, working closely with the Ethereum Foundation and leveraging its deep connections to staking infrastructure, DeFi projects, and asset management. Chainlink's edge comes from its ability to support large-scale staking operations, providing reliable yields for institutional investors and boosting liquidity across the Ethereum network. Signals point to heavy ETH accumulation, both on-chain and through OTC deals. Major asset managers are quietly moving ETH into treasury wallets, setting the stage for a possible supply shock. If demand continues to outpace supply, Ethereum could see another breakout, driven not just by retail speculation, but by strategic institutional positioning. The infrastructure is in place, and the appetite for yield is growing. For those watching closely, the next phase of the bull run may be led by Ethereum and its network of institutional partners. But the story doesn't end with Bitcoin and Ethereum. The altcoin market is alive with opportunity, driven by partnerships, infrastructure growth, and accelerating institutional adoption. Chainlink, for example, has seen reserve accumulation spike to over 44,000 Link in recent weeks. This is not random buying. It's targeted, strategic positioning by entities looking to leverage Chainlink's Oracle technology for secure, scalable data feeds in DeFi and beyond. VeChain, VET, is another standout. The blockchain platform recently announced a landmark partnership with Franklin Templeton, a global asset manager with $1.7 trillion in assets under management. This collaboration opens the door for enterprise adoption, supply chain transparency, and new financial products built on VeChain's robust infrastructure. When institutional capital flows into altcoins, it often signals the start of a broader adoption cycle, one that can drive prices and innovation for years to come. The appetite for crypto exposure on Wall Street is reaching new heights. Bullish Exchange, a hybrid trading platform, recently completed its IPO with a jaw-dropping 90% pump on day one, pushing its market capitalization to $10 billion. This isn't just speculative hype. It's a clear indication that traditional financial institutions are hungry for crypto infrastructure, trading platforms, and on-chain liquidity. As these exchanges grow, they create new gateways for institutional capital to flow into altcoins, DeFi, and blockchain projects. What does this mean for retail investors? In short, these plays, Chainlink, VeChain, and Bullish Exchange, benefit directly from the infrastructure boom and institutional adoption. They're not just speculative tokens, they're integral parts of the new financial landscape. The projects that solve real problems, connect to legacy finance, and provide scalable solutions are the ones most likely to thrive in the next market cycle. So, where does all this leave us? In the short term, the market will continue to experience dramatic dips and surges. Headlines will come and go, each one stoking fear, excitement, or uncertainty. But the long-term fundamentals remain bullish. Governments, corporations, and institutions are positioning themselves now, buying during the dips, building infrastructure, and shaping the future of finance. Retail investors, unfortunately, often fall victim to the noise. Panic selling during corrections can lock in losses and miss out on the upside. Meanwhile, smart money, those with resources, patience, and strategic vision, use these moments to accumulate. The difference isn't just access to information, it's the ability to see through the fear narrative and focus on what truly matters: adoption, infrastructure, and long-term positioning. As we move deeper into 2025, it's clear that the stakes are higher than ever. Regulatory changes, institutional moves, and government strategies are converging to make this one of the most pivotal years in crypto history. The opportunity is real, but so is the volatility. Investors who stay informed, watch the data, and avoid being shaken out by headlines will be best positioned to benefit from the next wave of growth. Don't let fear control your decisions. The headlines may scream crash, but the data tells a different story. Behind the scenes, the world's most powerful players are accumulating, building, and preparing for the future. If you found this breakdown useful, take a moment to reflect on the underlying trends, not just the price action. Like, subscribe, and share your thoughts on Google's wallet ban and the broader market shifts. The more informed we are, the less power fear has over our money. This is the new reality of crypto in 2025. The infrastructure is evolving, the players are changing, and the opportunities are greater than ever. Whether you're holding Bitcoin, Ethereum, or the next big altcoin, remember, short-term dips are just noise. The fundamentals are strong, the adoption is accelerating, and the future belongs to those who can see beyond the headlines. Stay sharp, stay informed, and don't let fear dictate your financial journey.